Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Legend Holdings Corporation Annual Report. Legend Holdings Corporation operates in various sectors through its subsidiaries, providing a diverse range of businesses and services. The company's industrial operations segment offers intelligent devices and infrastructure, advanced material products, agriculture and food-related businesses, and integrated banking services. In addition to these operations, the Industrial Incubations and Investments segment invests in private equity and venture capital funds, makes angel investments in technology startups, and engages in various other business activities. These include aviation logistics, financial services, medical and healthcare, office leasing, car management software development, chemicals production, energy materials development, and real estate investment. The company also provides a range of services, including car services, information consulting, cold chain management, insurance, investment management, and medical consultation. Furthermore, Legend Holdings Corporation engages in agriculture product planting and trading, agricultural investment, logistics, food investment, seafood processing and sales, office building rental and services, new energy technology development, financial services, banking, and insurance. Overall, the company's business scope is extensive, covering various industries and sectors, both domestically and internationally. Legend Holdings Corporation market capitalization of $20 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Legend Holdings Corporation holds a significant advantage in their industry. Legend Holdings Corporation trades at a higher price-to-earnings ratio of 24 times and a lower price-to-book ratio of 0.31 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 86% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth can be categorized into several key areas. Firstly, diversified industries operations such as Lenovo and Levima Group experienced significant year-on-year revenue increases of 17% and 24%, respectively. Additionally, Joivio Group's expansion into emerging sectors like agricultural digital solutions and intelligent supply chain services contributed to its revenue growth. Another major driver of revenue growth was the consolidation of global animal protein supply chains, which led to increased demand for Lenovo's AI business, resulting in a triple-digit growth rate of 140% year-on-year. The company's PC business also experienced double-digit revenue growth, with a market share of 25.3%. Furthermore, the Infrastructure Solutions Group, ISG, and Solutions and Services Group, SSG, reported 37% and 19% year-over-year revenue growth, respectively. The Intelligent Devices Group also saw a 15% year-on-year growth, while the expansion into new energy materials, investment in biodegradable materials, and increased production capacity for EVA photovoltaic encapsulation film materials contributed to revenue growth. The company's market share and influence in China for PP thin-wall injection molding specialty materials also increased. In contrast, the primary drivers of revenue decline were limited to a few areas. Industry. Incubations and investments experienced a significant decrease in revenue, while Joivio Group and Lenovo saw minor decreases in revenue due to various factors such as decreased demand or market fluctuations. The net income of Legend Holdings experienced fluctuations throughout the period. Initially, it increased by 28% year-over-year to RMB 9,799 million on page 9. However, this trend was short-lived, as it decreased by 5% year-over-year to RMB 3,271 million on page 13. The company also reported a net loss of RMB 900 million on page 14, but expected to return to profitability due to cost savings. On the other hand, profit margins showed some improvement. On page 13, IDG operating margin was 7.1%, with revenue growth of 15% year-over-year. Additionally, ISG and SSG operating margins rose by 1.7 percentage points year-on-year to 22.4%. However, not all businesses performed well, as the China Starfish declined due to headwinds. The fluctuations in net income can be attributed to various factors, including changes in revenue growth and cost savings. The improvement in profit margins suggests that some business units are performing better than others. Overall, the company's financial performance is mixed, with both positive and negative trends observed throughout the period. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided information, there are multiple indicators that support this conclusion. On page 43, it is stated that net cash from operating activities for 2025 was RMB 123,421,119, which is a significant amount of money generated from operations. This suggests that the company's core business activities are generating substantial cash inflows. Further evidence can be found on pages 50 and 77, where different measures of operating cash flow are reported. On page 50, it is mentioned that cash generated from operations for 2025 was RMB 23 million, while net cash generated from operating activities was RMB 25,918,375. Similarly, on page 77, operating cash flow for 2025 was reported to be RMB 30,901,228. These figures collectively demonstrate that the company is indeed generating positive operating cash flow, which is a crucial indicator of its financial health and sustainability. The company's financial health is reflected in its debt levels and interest expenses. According to the extracted summaries, there are inconsistencies in the data provided across different pages. However, based on the most consistent information, it appears that the company's total debt has increased significantly by 9.7% from RMB 131,245 million to RMB 143,673 million. On the other hand, interest expenses have decreased. The interest expense for bank loans and overdrafts decreased by RMB 630,229, while the total finance costs decreased by RMB 122,408. This decrease in interest expenses is a positive indicator of the company's financial health, suggesting that it may be able to manage its debt more efficiently. Overall, the data suggests that the company's debt level has increased significantly, but its interest expenses have decreased. The recent performance of Lenovo's various segments and regions has been a mixed bag. On the positive side, the company's PC business, AI PCS, Moto Brand, Infrastructure Solutions Group, AI Server Business, and Solutions and Services Group have all performed well. These segments have seen significant growth and success, contributing to Lenovo's overall revenue. In contrast, some areas of the company have struggled. The incubations and investments industry has been a poor performer, as have the Joivio Group and Levima Group, which are part of Lenovo's diversified industries operations. Additionally, BIL has also seen underwhelming results. These segments will require attention and improvement to ensure Lenovo's continued success. Management is optimistic about the company's outlook, citing several key strategies that will drive growth. One of the main focuses is on scientific and technological innovation, which has already led to global leadership in various fields. The company plans to continue investing in commercializing early-stage technologies. In addition, management emphasizes the importance of green development and achieving net zero greenhouse gas emissions by 2050. This commitment to sustainability will not only benefit the environment, but also drive long-term growth and profitability. The company's mission is to revitalize the country through business, which involves pursuing long-term growth and a strategic layout in its operating fields. Management is confident that this approach will lead to record highs in EVA production and sales, as well as market expansion with new high gross profit products developed. Furthermore, management highlights the company's strong financial performance, including a 37% year-on-year increase in ISG revenue to RM 100 and 26.2 billion. This growth is expected to continue, driven by accelerated development of cloud infrastructure and AI server businesses. Overall, management's outlook for the company is positive, with a focus on innovation, sustainability, and long-term growth. The company is well-positioned to capitalize on emerging trends and opportunities in various industries, including artificial intelligence, semiconductor, new energy, and medical and healthcare. The company's financial activities have been transparently documented. One notable aspect is the payment of dividends to its shareholders. This indicates a commitment to rewarding investors for their loyalty and trust in the company. On the other hand, there has been no record of share buybacks. This suggests that the company may be prioritizing other uses of its funds or focusing on growth initiatives rather than returning value to shareholders through this means. Concerns about inventory buildup and supply chain disruption are evident in various sections of the report. On page 2, global industrial and supply chains faced mounting security threats, which could potentially disrupt supply chains. Furthermore, on page 12, component shortages and rising costs driven by supply-demand imbalances and uncertainties around U.S. tariff policies pose a significant threat to smooth supply chain operations. The issue is also highlighted in the China starfish section on page 22, where constrained international supply of raw materials and inventory destocking in downstream markets have caused downward price pressure. This indicates that there are potential issues with inventory buildup and supply chain disruption. Additionally, on page 61, an increase in inventory write-down from 126,525 to 737,736 suggests that companies may be struggling with managing their inventories effectively. These concerns suggest that the current state of global supply chains is precarious, with multiple factors contributing to potential disruptions and inventory buildup. That concludes the financial summary for Legend Holdings Corporation. Feel free to comment below, and I will be happy to answer them when possible.